Assalamu alaikum again, dear students. Let's discuss chapter 6. Though we have already finished the chapter, I think you have requested me that you will require the chapter 6 video lessons. Fine, so here we are, chapter 6, which speaks about master budget and responsibility accounting. So let's go on and have a look at what is a master budget. We'll talk about the technique of the budget, and we'll talk about what is master budget in chapter 6. You have already seen the video for chapter 7 where we talked about flexible budgets. Moving forward, let's start with the definition of budget. A budget is just a quantitative expression of a proposed plan of action by a management for a specified period. This is the definition which we had used also in chapter 2, where we indicated that different tools of planning and controlling can be used by managers for various purposes. So for the budget, the main point here would be it is a quantitative expression. It means budget is a plan which takes into consideration only quantitative aspect. So we say it is a proposed plan of action by management for a specified period. So it's very important that the budget needs to be specific plan which is discussed in quantitative terms, and the plan is supposed to be for a particular period. So a budget is an aid, or it helps in coordinating what needs to be done and to implement that plan. So we say that a budget basically includes both the plan's financial as well as non-financial aspect. So again, I would like to talk to you about the quantitative aspect. When we said quantitative, it doesn't mean that it's only in terms of dollars. The plan can be both in terms of dollars and any other number which serves as a blueprint or a plan, or the basic or the main plan for the company to follow in an upcoming period. Next, we talk about how budget helps managers. So basically, budgets can make the communication of the management with their subordinates quite easy, such that the managers can communicate the direction and goals to different departments without having to use too many words. Most of the companies rely on simply the budget to help the managers both in terms of communicating as well as coordinating the actions of different departments, so that they could pursue and satisfy the customers and also attain their success. Secondly, budget helps companies to judge performance by measuring the financial results of their planned objectives, activities, and timelines, so that they could learn about any potential problem which may arise. And the last benefit of budget to the managers is it is a tool that motivates employees to achieve their goal. So basically, companies use budget to let the employees know what they are expected to perform in an upcoming period, where they could use this as a means of judging the performance of the employees, as well as motivate the employees so that they know what their goals are and help them in achieving their goals. Next topic, these are all little concepts like managers need to ask few questions so that their operating and strategic plans can be achieved. So the questions that the managers need to know before they prepare their plans is, what are our objectives? Meaning the manager needs to be aware of what type of objectives the company is having, both in terms of strategic objectives as well as operating objectives. How do we create value for our customers while distinguishing ourselves with the competitors? I think this was something which we had already discussed about the company in terms of where do the managers actually start from. So the managers have to talk about what type of values they create for their customers. If you remember from chapter 1, we were talking about the value chain. And again, being competition, the managers also need to know how exactly they are different from the competitors that they are facing. Are the markets for our products local, regional, national, or global? The manager also need to be aware before they make any plan about the type of market that they have, whether their products are being sold locally, regionally, nationally, or even internationally. The next question that the manager needs to know is what type of trends would affect their market, whether it is a seasonal trend, maybe a periodic trend, or whatever type of trend that can affect their markets. What organizational and financial structure should serve the company best? So this is something which the budget is not going to help them answer. The company needs to know about it by themselves, and based on these information, the company is going to prepare the budget. Final question that the manager need to already know about is the type of risks and opportunities that are available to them, the alternative strategies that they can operate, and also any contingency plan if the budget that they make, that is the preferred plan or the master plan that they make, will fail. So these 6 points are basically the preconceived notion under which the managers have to work through with the budget. We'll talk about another concept called the budgeting cycle. Budgeting cycle are the steps that the managers have to undergo so as to attain the benefits of the budget. Basically, we talk about it in three points. The first point is even before the start of the year, the managers at every level will take into consideration the required information so as to make plans for the next period. So the information that the managers may use in order to create their budget or in order to have their plan is the past performance of the company itself, like how did they do in the previous period, maybe the feedback that they have got from the market, and also what type of changes are they anticipating in the coming future. So once they know this, they can start using this information as an indicator for the initial plan that they would be using for the next period. The second point, or we can the second step in the process of the budget, is that the senior management will have prepared a set of plan, which we may call it as a frame of reference, which the managers or the top manager gives to the subordinate managers, which will be used as a budget or maybe as the basic plan, which can be used to compare their actual results with the plan. And finally, the managers and the management accountant are going to investigate their actual or evaluate their actual and find if there was any deviation from the plan. So by now you already know that after preparing the master budget, the company is going to uh, perform, that is achieve their targets, and then at the end of the period they are going to see whether the targets that was I mean the actuals that was achieved was as good as the plan that was made. In other words, they are going to do the variance analysis. So let's in this slide we'll talk about the documents that will be used in the initial plan. If I'm going back to the previous slide, we were talking about the frame of reference. A frame of reference is nothing but the plan that or the initial plan that the company would be making so that each aspect of their performance can be compared to. This idea is also called the master budget. So here we'll talk about the various concepts or various contexts that constitute the master budget. When we say master budget, we need to understand that it is a set of different budgets which can be put together, which is put together by the company at the beginning of their uh, period uh, as a plan for the upcoming period. So this budget is at the core of any budgeting process. So we say that the master budget is at the core of any budgeting process. It expresses the managers or the management's operating as well as financial plan for a specified period. So when I say operating plan, it is the day-to-day plan or the way in which the management has to achieve the plan, and that is the operating plan, while the financial plan talks about the way in which the way in which the company will get the resources and make it available into the different parts of the company to get the work done. So operating plan or the operating budget deals with how best the limited resources of an organization will be used, and the financial decision or the financial plan, or in other words the financial budget, deals with how to obtain the required funds to acquire these resources. What are the advantages of budget? In fact, we are repeating this slide from the previous one, so very quickly I'll go across the 3 points. First one, it is a tool which helps in coordinating and communicating the plan with the different subunits of the company. Secondly, it provides a framework where the performance can be evaluated of the company, and also help the company to learn about potential problem that it may be facing. And finally, it can be a tool which helps motivate the managers as well as any other employee who fall in the purview of the plan. But we also need to remember that preparing a budget and executing it is not free from challenges. We'll talk about few challenges here in this slide. So the top manager wants the lower manager to participate in the budgeting process because as the top manager may not be having specialized knowledge that is required in the day-to-day management. On the other side, the budgeting process is quite time consuming. In fact, this is one of the greatest challenge of the budget, because preparing a budget or especially the master budget is not an easy task. It takes a lot of time, research and effort in order to put out all the figures that is required to make the budget. So it's very important that upper level management support is a must, or we can say it's very crucial. When we talk about the time coverage of the budget, most of the time we say that the timeline of the budget depends on why is the budget being prepared, and we discussed this also in chapter 1, where we said that the tools of managerial accounting do not have a specific time frame. It can range from hours to years. So in the same regard, a budget can also be prepared for various time context. However, most companies prepare budget every year, so the budget period is normally 1 year for most of the companies. So here in this slide we can also talk about the concept of rolling budget. So though we say that the budgeting period is 1 year if it was for a normal budget, but some companies keep preparing budget on a rolling basis. When we say rolling basis, it is the budget for the next period for one particular period ahead is always integrated within the budget which is being used. So this budget is always available for a specified future period by continually adding one extra month, maybe a quarter or a year according to the period that has just ended. So it means one period future budget is always there with the company as they are progressing through different time periods. So here this slide talks about the 5 steps in the decision making process. Basically these are the same 5 steps that we have talked about in chapter 1 where we were discussing the steps in the decision making. We need to understand that budget also follows these 5 steps in the decision making, where we said the first step is to to identify the problem, that is why do we want to make the budget, and then gather the information that is required to prepare the budget. Think about various opportunities or maybe the various um, options that can be available, and choose among the best option that you think, or maybe choose among the best plan which you think that would be useful in attaining the goals of the organization. And finally implement the plan and evaluate the plan evaluate the performance and also learn from the failures or the success of the performance evaluation. Here we'll talk about the operating budget, and we'll talk about the different steps in the operating budget. So basically here we are talking about the master budget and the various components of the master budget. Basically we can call it as the steps, or we could also call it as the components of the master budget. So you could see here the first step or the first component is the revenue budget. Basically this is considered to be the starting point of any master budget. The first thing a company does is estimate what exactly they are going to earn in revenue in the upcoming period. For a merchandising or a manufacturing company, this could be the number of units that they want to sell multiplied by the price. So we can call this as schedule 1 in the textbook. You can check this out as schedule 1, that is the revenue budget. The second budget which most companies, especially the manufacturing companies, prepare is the production budget. Notice that this is schedule 2 in the unit, and usually production budget is prepared only for the number of units, not in terms of the dollar quantity. The third budget in the operating budget is the direct material usage budget and the direct material purchase budget. Direct material usage budget is in terms of quantity or the number of units of direct material that will be required, and the direct material purchase budget will use the usage budget and multiply it with the cost of the materials to find the dollar value of the budget. Check this out as schedule 3 from your textbook. Next in line would be direct manufacturing labor budget, which would be schedule 4 from your textbook. This budget constitutes the number of hours required in terms of direct manufacturing labor, and then of course multiply it with the the rate per hour for direct materials, direct manufacturing labor. The next budget, that is budget number 5, could be the manufacturing overhead budget, which is nothing but an accumulation of all indirect costs related to manufacturing, and you will see a schedule 5 which shows how this particular budget could be prepared. The next budget is the inventories budget. Again, you need to remember from chapter 2 that inventories could be direct material inventory, work in process inventory, or the finished goods inventory. All these type of budgets can be prepared as per few templates, two templates that's been made available for schedule 6A and 6B. Of course, it's prepared in terms of dollars. And the next budget is the cost of goods sold budget. If you remember, this terminology we had already used in chapter 2, where we know that cost of goods sold is equal to cost of goods manufactured after adjusting the finished goods inventory. So basically schedule 7, you will notice that cost of goods sold follows similar norm as we saw in chapter 2. The next budget is the operating expenses budget, or in other words the period cost budget, which is nothing but an accumulation of all the indirect expenses beyond the manufacturing, which you may want to add, and then you will see that in schedule 8. And the last budget under the operating budget is the preparation of budgeted income statement. You will notice this one in your textbook under exhibit 6-3. Budgeted income statement follows the same format as a normal income statement. However, since it is budget, we also use the word pro forma income statement for a budgeted income statement. Continuing my discussion about master budget, we also need to understand that the total master budget is divided into two types of budget: the operating budget and the financial budget. A financial budget constitutes of four main budgets. That is capital expenditure budget, which means a budget which plans out how the required capital would be arranged for in order to purchase the fixed asset requirement of the upcoming period. The next budget is the cash budget. It plans out the way in which the cash inflows and the cash outflows would be planned for the upcoming period. And then a pro forma balance sheet and a pro forma a statement of cash flow would be prepared such that the financial budget would be composed. However, I'm just glossing through these four topics as it's not forming a part of our chapter. Though, if you want to find more information, check the appendix part of this chapter in your textbook. So, to have an overview of the master budget, I'm just wanting you to have a look at this diagram, which talks about the various budget which I just covered in the previous slides. So, we have the revenue budget, followed by the production budget. Now, once you have these two budget, you can actually prepare your ending inventory budget, and you could then go on to prepare the direct material budget, direct manufacturing labor budget, and manufacturing overhead budget. Adjusted with the ending inventory, you could prepare the cost of goods sold budget, and then you can individually prepare all your period cost budget, like the R&D or the design cost budget, the marketing budget, the distribution budget, and so on. Once you're done with all your period cost budget, you could finally prepare the budgeted income statement. So you will notice that this part of the diagram talks about the operating budget, and the remaining budget which is prepared for showing how the resources will be managed in order to achieve the operating budget. I mean the financial resources will be managed. Then you prepare your capital expenditure budget, the cash budget, the budgeted balance sheet, and the budgeted cash flow statement. So the budgeted financial statements are usually called pro formas. With that, we end the topic of master budget. You need to understand that master budget is called as a static budget in the upcoming chapter, and we are going to use that term while we discuss the variance analysis in chapter 7. We continue talking about some small topics, like we talk about financial planning models and sensitivity analysis. And sensitivity analysis. When I say financial planning model, we are referring to some maybe applications or softwares which companies use as a financial planning tool. Uh, Among them is sensitivity analysis, which is a tool which the managers use in order to plan for their master budget, where they could see the results of different changes that they want to make to their original plan. So let me explain financial planning model, which can be some technique which the managers use in order to help them in the budgetary process. So here we'll in this slide we'll talk about a technique called as sensitivity or what if analysis. So a what if analysis or a sensitivity analysis is a technique which examines how the result will change if the original predicted data, that means your master budget data, or any assumption underlying it would change. To demonstrate that, I would want you to understand sensitivity analysis. Maybe it's an Excel worksheet where you want to put in your master budget data, maybe in terms of different aspects like maybe the unit sold, the selling price, the direct material cost, or the maybe budgeted operating income. So basically, maybe you want to monitor what happens to your operating income if any item of your master budget changes. So let's say in the first row, suppose you put the item of the master budget for the unit sold. In this example, you will see there are two products, the casual and the deluxe, and they've given you uh, the revenues or the number of units sold. Here they talk about the selling price or maybe material cost or many other things which may not have been considered here. So under the sensitivity analysis, what you would do is you would apply the formula on how using this information the operating income is calculated, and then copy the same formula to the following rows and then try to make some changes to your master budget assumption. So maybe here in this Excel sheet, two scenarios have been explained. The first scenario, what happens if the selling price does not stay according to your original plan. So in this example, you will notice that the master budget says that the selling price was 600 and 800 for the two products. But in our scenario one, we assume that if the selling price is not 600 for casual but 582, then what would happen to your operating income? Similarly, if your selling price for the second product, that is deluxe, is not $800 but $776. So you will notice that the Excel sheet would automatically calculate the operating income based on the assumption under the first scenario, and it will also tell you that if the selling price decreases, then the operating income would also decrease, and in this example it would decrease by 22%. Similarly, in the second scenario, the changes was made to the material cost. If you will notice, the budgeted material cost was, according to the master budget, it was $7 and $10 respectively for the two direct materials. While you make a change here and then assume that what if the cost of material changes from $7 to $7.3 for red oak and $10 to $10.5 for the granite, then you will notice that your operating income will not be as much as your master budget operating income, and it's going to decrease by 8%. In the same way, you could have innumerable number of scenarios and evaluate what would happen if the uh, if any of our assumptions in terms of the unit sold, selling price, or any other cost would change, what would be its impact on the budgeted income statement. So based on this tool, you could decide on which is the best option for any of the assumptions that you want to make so that you can use it in your master budget. So from this slide, I would just want you to highlight that sensitivity analysis is called as a what if technique because it illustrates the impact of changes from the predicted data. Basically, you ask the question, what happens if we make any change to any of our assumption that we have made for our master budget? In the upcoming slide, I think we are simply talking about a few more concepts. Here, this concept is about responsibility accounting. So basically, when we talk about budgets, the idea that a budget is a plan and the people in the organization need to know what the plan is, and we need to identify people within the organization who will be responsible for achieving that plan. So this aspect of the managers who is responsible or who is accountable to achieve a particular activity according to the master budget is called the activity center or the responsibility center. The responsibility center is a part of the organization, any segment, or maybe a subunit of the organization whose manager is responsible for achieving a particular part of the master budget. Depending on the level of responsibility that a responsibility center has, the responsibility center can be divided into four levels, and those four levels are the cost center, where the responsibility center is responsible only for the spending aspect of the plan, meaning that if a responsibility center has no other responsibility than to maintain the cost according to the plan, such type of responsibility center is called the cost center. So an example for the cost center may be the production department, which is responsible only to produce and maybe only to spend in terms of the materials, labor, etc. Maybe even the purchase department could be a cost center. Second level of the responsibility center is called the revenue center, where the center is responsible only to generate revenue. So they are not responsible for spending, but they are responsible for generating revenues. I don't know, maybe the sales counter in any departmental store can be considered to be a revenue center because the person or the manager of the sales counter is responsible only for generating the revenue and is not expected to spend any amount. The next level is the profit center. So if the responsibility center is responsible for both revenue as well as cost, then such a center is called the profit center. Maybe a branch manager of a bank, or maybe even the cash counter of a bank, where they are responsible for generating both the revenues as well as spending the amount. Finally, the investment center, it is considered to be the highest level of responsibility center. Here, the managers are accountable not only for the revenues and the cost, but also to arrange the funds that would be required for spending, and also to make the investment decision after they have received the revenue. We'll talk about budget and its role in providing feedback. Basically, budgets are plans which are supposed to be implemented, and once it is implemented, companies have to compare their plan with their actual and derive the variances, which is nothing but the actual result, whether it deviates from the budgeted amount. So when the company is doing that, basically it provides you with a feedback on whether the company was able to achieve the plan or not. So budget acts as a powerful tool for feedback for any company. So feedback is provided in the form of variances, and variances help the manager by providing early warning to any problem uh, which may be a cause of maybe the failure of a company in achieving their plan. Basically, the variances may be used as a basis for evaluating the performance of the responsibility center or the manager of the responsibility center. It can also be used as a basis for evaluating the strategy of a company. The next slide, here we just take a concept called as controllability. We already discussed what is responsibility. So responsibility is the level of accountability a particular cost center or a responsibility center has in terms of achieving the plan of the organization. Now we need to understand that a manager who has a responsibility will not be able to achieve the responsibility unless a certain degree of rights or authority is given to a manager so that he is able to achieve the plan. So controllability refers to that right that is given to the manager so that he can achieve the plan for which he is being held responsible. So controllability is the degree of influence that a manager has over the cost, revenue, or any other related item for which he is being held responsible. Responsibility accounting is nothing but dealing with the responsibility and then identifying whether the manager was able to achieve his responsibility or not, so that you can get information and not that you have to blame a manager. So responsibility accounting focuses on gaining information and knowledge, not only to achieve control. So the purpose of responsibility accounting is mainly future improvement and not blaming any person for not achieving the plan. We'll talk about some human aspect of budget. Basically, we'll talk about two concepts. The first one is called the budgetary slack. Budgetary slack is the practice where the manager or the subordinate underestimates the budgeted revenue or overestimates the budgeted cost, so that the budgeted target seems to be easier to achieve. Next is the stretch target. Now this is also an human aspect, but basically it's done by the top manager, where they would want to give some challenging but achievable targets to their subordinates so that they can be motivated to achieve those targets. Next concept is Kaizen budgeting, where Kaizen, which means continuous improvement, is applied to the practice of budget so that the companies or the organization can implement or maybe can apply the concept of Kaizen and have a goal of continuous improvement from their past results. Uh, I think here we have come to the end of this chapter. Basically, in the final slide, we simply say that for a multinational company, budgeting involves all the challenges that we have discussed, and the additional challenge that they face is the foreign exchange risk, which the companies face, which adds to the complication of preparing the budget and maintaining it, specifically in conditions where the international market is quite volatile. So, with that, we end the chapter. Thank you very much for listening, and I hope this was useful to you.